Welcome back to the podcast, Generate Income by Selling Options. In the previous episode, we mentioned several strategies that are used in options writing, aka options selling. One of those particular strategies that our speakers discussed was covered calls. In this episode, we want to dive deeper into what covered calls are and how you can use it to generate income. So, with that said, let's bring in our hosts to dive into covered calls. And as a reminder, please subscribe to this podcast channel in order to stay tuned for upcoming episodes. The mic is all yours, Adam and Isla.
Okay, so we've got a stack of articles here all about covered calls.
Yeah.
And, I think this is going to be a really fun deep dive.
Yeah, it's a fascinating topic.
It is. And, this strategy lets you potentially earn some extra income
Right.
from stocks you already own. So
Yeah.
imagine getting paid just for holding on to your investments.
It's a really cool idea, and
Yeah.
it can be very powerful.
It's kind of like renting out your house, right?
Yeah.
You still own it,
Yeah.
but someone else is paying you for the right to buy it.
That's a great analogy. That's a
Yeah.
really good way to think about it.
Yeah.
You own shares of a stock, and you're basically selling someone the right,
Right.
but not the obligation to buy those shares from you at a certain price.
Mm-hmm.
We call that the strike price
Right.
by a certain date, and that's the expiration date.
Okay.
And for that, right, they pay you a premium.
So is there a time is money element to it then?
Definitely. Yeah, absolutely.
Yeah.
The option buyer is essentially betting that the stock price is going to go up
Right.
above that strike price before the option expires.
Okay.
And they're willing to pay you for the chance to profit from that price movement.
That makes sense.
Yeah,
So what happens then even if the stock price doesn't move that much?
right.
Or even if it goes down a little bit?
Well, you still keep that premium
Okay.
that you received when you sold the option.
Okay.
That's where the income generating potential comes in.
So walk me through like the different scenarios here.
Sure.
Let's say I sell a covered call on a stack that I own.
Okay.
What happens if the stock price stays below the strike price?
That's the ideal scenario for a covered call seller.
Okay.
The option expires worthless
Okay.
because the buyer wouldn't exercise their right to buy your shares at a price that's higher than the current market price.
Right.
So you get to keep the premium.
Okay.
You keep your shares.
Everybody wins.
Yeah, everybody wins.
Except maybe the option buyer.
Yeah, maybe the option buyer, but,
Right.
that's part of the game.
That's the risk they take.
Exactly.
Now, what if I'm wrong
Right.
and the stock price actually takes off
Okay.
and
Yeah.
goes above the strike price?
Well, in that case, the option buyer would likely exercise their right to buy your shares
Okay.
at the strike price.
Uh-huh.
So you have to sell your shares,
Okay.
but you still keep that premium that you received up front.
So I don't participate in that upside then
Right.
beyond the strike price?
Yeah, that's the trade-off.
Right.
You're getting some income.
Yeah.
You're getting a little bit of downside protection,
Okay.
but you are giving up the chance for those bigger profits
Right.
if the stock really takes off.
So it's almost like you're setting like a target selling price
Yeah.
for your stock.
Yeah.
You're saying, okay, I'm happy to sell at this price.
Right.
And I'm going to collect some extra income along the way.
Exactly.
So then that brings us to, I guess, like the when to use and when to avoid aspect of covered calls.
Yeah.
Yeah.
If I'm super bullish on a stock
Right.
and I think it's just going to skyrocket,
Yeah.
covered calls are probably not the best strategy then.
Probably not the best. I mean, it depends on your goals, but
Yeah.
if you think it's going to double or triple,
Right.
you probably want to participate in all that upside.
Okay.
Covered calls are generally best for stocks
Yeah.
that you expect to remain relatively stable or maybe rise slightly.
Mhm.
They're not for those stocks that you think are going to just go through the roof.
So I'm starting to see like this strategic element here.
Yeah.
It's not just blindly selling covered calls on any stock that I own.
Right?
You need to kind of have a view on the stock,
Yeah. You need to have a view.
on its likely price movement, and tailor your strategy accordingly.
Exactly. And that's why it's so important to understand all the ins and outs of covered calls.
Let's talk about that.
Okay.
What are the advantages, then, of using this strategy? Well, as we've touched on, the biggest pro is that income generation.
Right.
You're essentially creating an additional revenue stream from your existing stock holdings.
So you're saying that can be especially attractive
Yeah.
in a market where maybe prices aren't moving that much.
Right,
Or
exactly.
they're even declining slightly.
Yeah, if the market's kind of flat or even down a little bit.
So covered calls can offer a way then to potentially offset some of those paper losses.
They can, yeah.
Okay.
I mean, it's not a foolproof hedge
Right.
against losses,
Of course. Yeah.
but that premium that you receive can act as a little bit of a cushion.
Okay.
And there's another advantage we haven't talked about yet.
Okay.
Covered calls can be a way to strategically exit a stock position.
Oh, interesting. Tell me more about that.
So let's say you own a stock
Okay.
and it's gone up in price
Right.
and you're thinking about selling it,
Mm-hmm.
but you're not quite sure, like, when's the best time to sell.
Okay.
You could sell a covered call with a strike price near your target. And if the stock price stays below the strike price, you keep the premium.
Okay.
You continue to own the stock.
But if the stock price goes above,
But if it rises above the strike price,
right.
then the option buyer exercises their right,
Uh-huh.
and you're obligated to sell your shares
At that predetermined price.
at that predetermined price. Exactly.
So it's like setting a limit order.
It's very similar.
Yeah. But you're getting paid to do it.
You're getting paid to do it exactly.
That's a great point.
Yeah.
So we've talked about all these advantages of covered calls.
Yeah.
But there's got to be some downsides, right?
Of course.
What are the risks or drawbacks that investors should be aware of?
The main drawback, like we've already discussed, is you're limiting your potential upside.
Right.
You're missing out on those gains above the strike price.
Right. And there's also the risk of being assigned,
Yes,
even if the stock price is only slightly above the strike price, right?
exactly.
Okay.
Remember, the option buyer has the right, but not the obligation to buy your shares.
Right.
So even if they're only making a small profit,
Mm-hmm.
they might still do it.
And let's not forget the tax implications.
Yeah. Taxes are always a consideration.
Right.
Anytime you're realizing a gain.
Yeah. Selling a covered call is a taxable event.
It is.
So you got to factor that into your overall investment strategy.
Absolutely. And that's something that often gets overlooked.
Yeah.
People get so focused on the potential gains,
Right.
they forget about the tax man.
And especially, if those unrealized gains are substantial,
Right.
selling the shares could lead to a big tax liability.
It could.
Yeah.
So you definitely want to be aware of that.
Okay. I think we've covered a lot of ground here. We
Yeah.
have defined what covered calls are,
Yeah.
how they work, the pros, the cons.
Yeah.
But I want to make sure that our listener understands this key concept that came up. Time decay.
Yeah.
Can you explain what that is
Sure.
and why it's important for covered call sellers?
Time decay, also known as theta, refers to the fact that options lose value as they get closer to their expiration date.
So as you get closer to the
Yeah.
expiration date.
It's like an ice cube melting.
Okay.
The closer you get to the expiration date,
Mhm.
the less value the option has.
And so why does this benefit the covered call seller?
Well, as the seller, you've already received the premium
Right.
up front.
Okay.
So as the option is losing value over time, you're essentially making more money. Even if the stock price doesn't move much, time decay is working in your favor.
Okay, so even if the stock price stays below the strike price
Right.
and the option expires worthless, I'm still coming out ahead
You're still coming out ahead
because of time.
because of time decay. Yeah.
That's a great way to put it.
Yeah.
So in the last part, we established that covered calls are kind of like
Yeah.
setting a target selling price for a stock you already own.
Right.
And we talked about how that whole time decay thing works in your favor.
Yeah. Time decay is a beautiful thing.
It is, but one thing that's still kind of fuzzy for me is how to choose the right strike price.
Okay.
It seems like there's a trade-off there between getting a higher premium
Right.
and then minimizing the risk of having your shares called away.
Yeah. That's the key decision right there.
Yeah,
When you're selling a covered call is
right.
what strike price to choose.
So let's unpack that trade-off a little bit further then.
Okay.
If you choose a strike price that's way above the current stock price,
Right.
the premium that you're going to receive is lower.
It'll be lower. Yeah, because it's less likely that the stock's going to reach that price
Right.
before the option expires.
But then if the stock does go up significantly,
Yeah,
I'm missing out on a lot of potential profit.
exactly. You're leaving money on the table.
Okay.
On the other hand, if you choose a strike price that's really close
Yeah.
to the current stock price,
Mm-hmm.
the premium's going to be higher
Okay.
because it's more likely to be in the money.
But then I have a higher risk of being assigned
Right.
and having to sell my shares,
Exactly.
even if the stock price only goes up a little bit.
That's the trade-off.
Yeah.
Higher premium,
Yeah.
more risk of assignment.
So how do I find that sweet spot then?
Right. Well, that's the million-dollar question, isn't it?
Yeah.
There's no magic formula.
Right.
But there are a few things you can do.
Okay.
One of the articles that you shared, the covered call option strategy,
Mhm.
it suggests a few helpful approaches. First, you got to consider your outlook for the stock.
Okay.
Do you think it's going to stay relatively stable, or do you expect it to move significantly in one direction or the other?
Right. So if I'm expecting these huge price swings.
Yeah, if you're thinking it's going to go way up or way down,
Yeah.
covered calls might not be the best.
Okay.
Another thing you can do is look at the stock's chart
Okay.
and try to identify any levels of resistance.
Resistance. What's that?
Resistance is basically a price level where the stock has historically had trouble moving higher,
Oh, okay.
like a ceiling.
Okay. Got it.
So if you set your strike price near a resistance level, you're essentially betting that the stock won't be able to break through that ceiling.
Okay.
You're less likely to be assigned.
That makes sense.
Yeah. And the article also mentions using delta to kind of estimate the probability
Okay.
of the option expiring in the money.
Now, I remember we talked about delta very briefly before, and that's one of those Greek letters
It is, yeah.
that make options trading seem a little bit intimidating.
It can be a little bit scary.
So remind me what delta is
Okay.
and how it can help me choose a strike price.
Delta basically measures how much an option's price is expected to change for every dollar move in the underlying stock. So think about it like this.
Mm-hmm.
If a call option has a delta of 0.5
Yeah.
and the stock price goes up by $1,
Mm-hmm.
the option price is expected to go up by 50 cents.
Got it.
Okay.
Yeah.
So delta can also be interpreted as a rough estimate
Okay.
of the probability that the option will actually expire in the money. So a call option with a delta of 0.25 suggests that there's roughly a 25% chance
Okay.
that it's going to be in the money at expiration.
So if I want to minimize the risk then of my shares being called away, I would look for call options with a lower delta. But I'm also getting a lower premium then.
Lower delta, lower premium.
It's that trade-off again.
It is. It all comes back to that trade-off.
If I'm more comfortable with the risk and I want to collect that higher premium.
Right. If you're feeling a little bit risky, you might go with a higher delta.
Okay, so to recap, when choosing a strike price, I need to consider my outlook for the stock,
Right.
identify any potential resistance levels,
Yep.
and use delta to estimate that probability of assignment.
You got it.
Okay.
That's a great summary.
Okay.
Choosing the right strike price is probably the most important decision
Right.
you're going to make when you're selling covered calls.
Now, once you've sold that covered call,
Yeah.
you're not stuck,
So
right?
you're not stuck at all.
There are ways to actually manage your position
Right.
as the market moves.
You've got options, which is kind of ironic when
Yeah.
we're talking about options.
Yeah.
But yeah, you can adjust your position as needed.
So tell me about some of these management techniques.
Okay. One of the most common and useful techniques
Yeah.
is called rolling. Yeah. So basically what you're doing is you're closing out your existing covered call position.
Okay.
And you're simultaneously opening a new one with a different strike price or expiration date.
Okay, so why would I want to do that?
Well, let's say, for example, you sold a covered call and the stock price starts moving up
Yeah.
more than you anticipated.
Right.
You still think the stock has room to run, but you don't want to be forced to sell your shares
Right.
at that original strike price.
Okay, so I could roll my covered call then by
Exactly.
buying back the original call option
Right.
and selling a new one with a higher strike price.
You got it.
So that gives me a more upside potential.
More upside potential.
Okay.
You're still collecting premium,
Yeah,
but you've adjusted your position
right.
to reflect what's happening in the market.
That's a clever way to stay in the game.
It is, yeah.
But manage your risk. What are some other reasons to roll a covered call then?
Another reason might be that the stock price is moving in your favor, and your original call option
Mm-hmm.
is getting close to its expiration date. You might want to roll it out
Okay.
to a later expiration date to continue collecting premium.
It's like extending the lease
Exactly.
on your rental property.
Yeah, it's like you're getting paid rent for
Right.
a longer period of time.
But each time you buy and sell an option, you incur transaction costs.
That's right. There are always costs involved.
So you've got to weigh those costs against the potential benefits of adjusting your position.
Absolutely. You always got to be mindful of those costs.
Okay, so are there any other techniques for managing covered calls?
Yeah. Another option is to just buy back the call option to close out the position entirely.
Mm-hmm.
That might be a good move if the stock price is moving against you
Okay.
and you just want to cut your losses. Or maybe you've just changed your mind about the stock. You think it's got more upside potential than you initially thought.
Sometimes it's better to just admit you were wrong.
Sometimes the best trade is the one you don't make or the one you get out of early.
That's very true. And then, of course, if the stock price stays below the strike price,
Yeah.
you can always just let the covered call expire.
Let it expire worthless.
Yeah.
You keep the entire premium.
Yep.
And you still own the shares.
So there are a few options then for managing covered calls once they're in play.
You've got some flexibility.
You can adjust your position.
Yep.
Take profits, cut losses as needed.
As needed, exactly.
Based on, your outlook and market conditions.
Market conditions are always changing.
It sounds like covered calls require a certain mindset then.
They do?
You need to be comfortable with managing your positions actively.
Yeah.
Maybe even a little bit of uncertainty.
Uncertainty is part of the game
It is.
when it comes to investing.
Now, one of the things that struck me as we were going through these articles is that covered calls seem like a strategy that rewards patience and discipline.
Absolutely.
Right.
It's not a get-rich-quick scheme.
Yeah.
It's about generating consistent income
Mm-hmm.
and enhancing returns over time.
It's like a marathon, not a sprint.
Exactly.
You got to have a plan, stay focused,
Yeah.
and be prepared to adjust that strategy along the way.
That's a great way to put it.
Okay, so we've talked about, choosing the right strike price.
Yeah.
We've talked about managing your position. But there are also some common mistakes that people make with covered calls, right?
Oh, yeah, absolutely.
What are some of those?
I think one of the biggest mistakes is selling covered calls on stocks that
Yeah.
they don't actually want to sell. Remember, if that option is exercised,
Yeah,
you are obligated to sell those shares
at the strike price.
at the strike price.
Right.
So you need to be comfortable with that possibility.
So it goes back to that idea of setting that target selling price.
It does.
You need to be okay with selling at that price,
Yeah,
even if the stock goes higher later on.
exactly.
Okay, what are some other mistakes that people commonly make?
Another common mistake is not paying attention to the expiration date.
Oh, right.
Options have a limited lifespan,
Okay.
and it's important to know when your covered call is expiring.
So you can make a decision
Right.
about whether to let it expire,
Right.
roll it out to a later date,
Yeah.
or buy it back to close out the position.
Exactly. So you got to stay organized. Keep track of your positions.
And one final point that's often overlooked, taxes.
Taxes, yeah, we talked about that a little bit earlier.
Yeah.
Selling covered calls can create taxable events. So it's really important to consult with a tax advisor
Yeah.
to understand all of the potential consequences.
I think we've given our listener a really solid understanding of covered calls
I think so.
so far.
Yeah, we've covered a lot of ground.
We have. But I'm curious to explore some alternative perspectives on this strategy.
Okay.
Is there ever a time when covered calls might not be the best choice?
Right.
Even if they seem to fit the criteria that we've been discussing?
Yeah, that's a great question, and the answer is definitely yes.
Okay.
There are times when covered calls might not be the best fit.
There are times when covered calls might not be the best choice.
Right.
Even if they seem to fit all the criteria we've been discussing.
Right.
So can you kind of elaborate on that a little bit?
Sure. So remember, covered calls are not a one-size-fits-all solution.
Mm-hmm.
They're a tool.
Okay.
And like any tool, they're only effective
Yeah.
if you use them appropriately.
So what are some scenarios then where covered calls might not be the best strategy?
Well, one scenario is if you're extremely bullish on a stock.
Okay.
If you really think a stock has the potential to just take off,
Yeah.
selling covered calls would limit your profit potential.
Because you're essentially capping your gains at the strike price.
Exactly.
Yeah.
If you think a stock's going to double or triple,
Yeah.
you don't want to sell a covered call
Right.
and miss out on all that upside.
Makes sense.
What else? Another time when covered calls might not be the best choice is when the market is really volatile
Okay.
or uncertain.
Right.
Covered calls are best suited for markets that are relatively stable
Mhm.
or slightly bullish.
Okay, so covered calls are a strategic tool,
They are.
and they're not always the right tool for the job.
All depends on the specific circumstances
Right.
and your individual goals.
Now, there are also some situations where
Yeah.
covered calls might seem suitable at first glance,
Mm-hmm.
but there might be other factors that make them less appealing.
Right.
For example, if you have a very low cost basis in a stock,
Yeah.
selling a covered call could trigger a big capital gains tax liability
Exactly.
if the option is exercised.
Taxes are always something to keep in mind.
Right. So it's important to consider the tax implications for selling covered calls,
Talk to your tax advisor.
especially if you're holding a stock with substantial unrealized gains.
Right. You might be better off just holding on to the stock
Yeah.
and deferring those taxes.
You know, one of the things that struck me when
Mm.
we were going through all these articles
Mhm.
is that covered calls seem to be a strategy that really rewards patience and discipline.
Absolutely.
It's not about getting rich quick.
Nope.
It's about generating that consistent income.
Yeah, slow and steady wins the race.
Right, and enhancing those returns over time.
Exactly.
It's a marathon, not a sprint.
You got to have a plan. You
Yeah,
got to stay focused.
right.
And you got to be prepared to adjust that strategy along the way.
Well said. I think we've explored covered calls from every angle here,
I think so.
and I hope our listeners feel equipped
Me too.
to make some informed decisions
Yeah,
about whether or not covered calls are right for them.
absolutely. Knowledge is power.
Well, on that note, we'll wrap up this deep dive into covered calls.
And make sure you subscribe to this podcast and follow us on X to be notified of our next podcast episode. Just click on that follow or subscribe button. Our X handle is the @ symbol, following by selling, the number 4, premium. All one word. It's been fun.
It has been. Thanks for joining us and happy investing, everybody.